Resnik, Chief Executive Officer of Finametrica. Paul, the floor is yours.
Good afternoon, everybody. I'm hopefully over the next hour I'm going to paralyse you with wit and intellectual challenge. What I'm going to take you through is essentially a trip through the philosophy of good advice. As sharing, I have little understanding of the complexity of Dutch culture and what you're growing up with, but I do, however, have a good understanding of how suitability, the matching of investments to the needs of customers, works around the world. So what you'll get is my perspective, my business's perspective on risk tolerance and the role it has to play. Now, for many of you, you may think, well, it's just risk tolerance. Of all of the things that we do in our business, wherever you sit in the service and supply chain, you may think, well, risk tolerance is just a little bit. I can just unplug whatever I'm doing, which might not necessarily work very well, and plug in something that will be a bit more defensible in the light of the new regulation. You may think that. Hopefully at the end of this hour or so, when we've had a chance to show how the integration works in the main software, you'll have a different view that when you do it properly, as we would argue, when it's done with intellectual academic rigour and with a commitment to the client, that it's well worth doing as well as you could do it. So if we start off with this image, in essence, this is where we want to get to. This is where we'd like our client to be. Yeah? In the financial planning process, you should be able to say, it's done. It's external to me. I know whatever happens, there will be assets available for my family and me, whatever the circumstances. For younger people, that will include insurance. We all self-insure. Our natural position in life, what are we? We're all insurance companies. We choose, if we're fortunate, to outsource some of that risk, don't we? We give it to a general insurer to insure our car, or a life insurance company, if we're insuring our life or our income. So we're all insurance companies. The mixture of suitability for younger people is this balance between understanding somebody's liabilities and asset matching. Bit of insurance, bit of self-insurance, and a little piece of investment. I'd like to believe that for all of us in the service chain, this similar model exists. We would all like to sleep at night knowing that what we've done for our clients also enables us to feel comfortable, knowing we've done the best job possible. Plan Plus Global is the owner of Finametrica. Finametrica and Plan Plus merged in August last year. Plan Plus was one of our clients. We had an integration. So if you imagine two businesses, we looked at the psychological preference for risk. Plan Plus was one of our integration partners. They were a calculator of risk. They did asset liability matching. We've been integrated for 10 years. It was a natural merger. What's risk tolerance? What's a risk profile? Risk tolerance is psychological. Risk profile is the wider personal definition of what's needed. Typical mistakes, so that you can see, I can share with you at least some of the flaws that exist in existing or even potential risk profiling approaches you take. Now, let me go at the moment to risk tolerance, because I feel obliged. That was my topic. Just talk a little bit about it. Risk tolerance is personality. Okay? It is normally distributed as a good way of explaining it. Some people are risk averse, some people are risk tolerant, and there's some people in the middle. The way we've done it, as we can see here, is we have, in our 25 question test, we have 7 risk groups, each a standard deviation apart. So the 2 outliers, one is low, 7 is high. 1 tend to be people that weren't brave enough to apply to school teaching as a career. And the 7s are people that have run a new absolute return fund every 6 months for the last 15 years, knowing that nobody will put them in prison. The vast majority of people are in the middle. Risk tolerance is persistent. Okay, that's another critical piece of this. It doesn't change with... So this is give or take 1 million test results on a monthly basis going back to 98. So the blue line here is males, red line females, and the green line, that's the MSCI. What do we know? We've now got results, just 1.1 million tests. We do a lot of work with universities saying, here is some data on risk tolerance and demographics and some other pieces. What can you make of it? So, it doesn't tend to change materially with age. As you get older, risk tolerance tends not to change. What does change is people's perception of risk. I am old, I am terrified, I've been told to be terrified, therefore I will be terrified. It doesn't tend to change with education. You think by showing people capital markets and other pieces you'll change their risk tolerance. That doesn't seem to work either. You may be able to change their short-term behaviour, but not long-term. What drives behaviour is not knowing things. It doesn't seem to be changed by market booms and busts. What happens is they see their friends liquidating, or they see their future melting away. They may know, as you would illustrate, markets have always recovered. There is no circumstance where a diversified portfolio hasn't done better in the longer term, ever, since we've got data. That doesn't stop people going, I am terrified. I need to bail. So booms and busts don't do it. Women are less risk tolerant than men. People in financial services are more risk tolerant than their customers. And what does that do? It means never answer the question which says, when a client looks up to you and says, Bob, what should I do? What would you do if you were me? Never project. Your client is different. The whole notion of the third limb, if you will, informed consent, is it's their decision. The term we use in Oz is that's the legal prophylactic. That's your defence. I took the client through it. This is how we looked at the alternatives. There were trade-offs. This is the one we took in this circumstance. And what do we think changes? Risk perception. If I've got a liability due, I'm going to be infinitely more concerned about the stock market, aren't I? So older people have liabilities due. They don't have other income necessarily. They're going to be much more reliant on capital value. So that's what we've learnt. 20 years, 1.1 million tests. Your clients, every one of them is likely to be slightly different, but only slightly. So, how do we personalise a portfolio? We use a broad set of trade-offs. It goes like this. Risk tolerance is one of 3 parts. It needs to be offset against actual calculations. What do I need to do to achieve whatever goal I've got? And what happens when it all go to hell? Risk capacity is the single most difficult process you can ever have to deal with. How little amount of money for how long can a client accept responsibility for? Is it going to be like 87? Or is it going to be like 2008? Is it going to be like 28, 29? What do you think the next correction of those three, which one would you like it to be? Which one is it going to be? And the answer is, we all don't know. So, doing the calculation of risk capacity is scenario testing with your assets, with your circumstances, with your needs to fund particular liabilities. Can we work our way through to make sure whatever sits there has a reasonable likelihood of success? That's our greatest professional challenge, because it's not just the financial assets, it's the other assets and the client's behaviour. Measuring risk tolerance is really easy. The client does it. Our 25-question test takes on average 15 whole minutes to do. Calculating risk required is looking at their spending patterns, their balance sheet and broadcasting. You can probably do that in an hour and a half or 2 hours once you've got the data. Risk capacity, particularly when you've got couples with different goals and aspirations. Where's our advantage? It's about working with clients, making the plan theirs, not the algorithms. It's theirs. And that's where getting risk tolerance right is really helpful. If you use risk tolerance and it varies, then you've added another variable. And so it was with enormous relief when we got enough data to believe that risk tolerance tends not to change. That doesn't mean at an individual level it doesn't change. It just means on average. Those three variables can be expanded, and this is a view of the other variables. You may look at this and just go, wow, but essentially this is what goes through your head if you're giving advice. You are weighing off people's risk perception, risk preferences, risk tolerances, risk required, risk capacity, going all the way down here to our portfolio, and then looking at products that solve that, and then starting again. So if you're an advisor, that's effectively what you do. When you build this into a scoring algorithm in a piece of software, do the same thing. When you do it in your own head, who knows what your biases might be? So we've just finished a piece of work with one of the American universities. We set up some case studies. We went to a bunch of advisors and say, how do you calculate the right answer? And then at the end we say, what have you weighed of these 10 variables? How have you weighed them in terms of order? And they split essentially between risk tolerance, risk capacity and risk required equally. So the primary weighting of a bunch of experienced advisors was different on their fundamental belief of what was the primary driver of giving advice. So let me give you an example of what that means. If you've got a younger person and it's a woman, likely to have a lower risk tolerance, likely to live forever. But if you give them a portfolio that's consistent with their risk tolerance, what will the cost be? Do you have cats in Holland? Yeah? You sell cat food? Yeah? So you're saying to somebody, based on risk tolerance, now the counter argument is I'll give you a portfolio consistent with risk tolerance because you'll live through all the variations more comfortably and you're less likely to make mistakes in your investing. So the long term you'll be better off. Well, here's an interesting challenge. How do you take notes to that effect and how do you test it going on? You might say, you are a younger person, you should have the highest exposure to risky assets that I can give you, and your risk tolerance is irrelevant. What's the right answer? There's a right answer for that client in your methodology. Huh? And if you push your risk tolerance, because if we did this, the bell curve of this room, it would be consistent with risk groups 5, 6 and 7. So in that example I gave you before, I said there was risk group 7 as the absolute return managers, was 1% of the population. I've been in rooms where it's been 25% of the room. Those are the gung-ho guys. Unlikely to be the gung-ho girls, but occasionally. And they're the ones that, you know, everything melts on them. You know, let me give you an argument. No, no better. I've been here. My worldview works. Okay, this is just a list of mistakes in risk profiling. I'll leave this with you. I'm just conscious that there's a lot of detail in this, but I wanted to make sure that these slides stand up to some rigour when you read them. Let me give you an example. Asking couples to answer the questions together. That would be a perfect example of a wrong way to do it. Coaching them through it. I know you can't read, you're too stupid, let me read you the questions. Yeah, that would be another example of how not to do it. One of the other ones that's running away, and it seems to be running here in Europe, is using gamble questions. We'll not assess risk tolerance. What we'll do is we'll give you some trade-offs. We'll show you this is gain versus loss, and you answer these questions till you find the tipping point. And they say, this is from Daniel Kahneman's prospect theory, so it has to be right. Utterly flawed. You do Latin here, ab initio. There is no link to how people view gambling and risk tolerance, and there is no capacity for most of us to do the calculation in a consistent way. Let us have a little thought experiment to do it, if you will. I'm going to ask you to calculate two numbers. Shout out the correct answer after I've asked the question. 4 times 5. 4 times 5? Oh, come on, you can't be Dutch, come on. Okay, 511 times 901. Now, what did you can see what happened there. You know you could do it, but you're not going to do it. Now imagine having a series of questions that hurt. Did that hurt? Of course it hurt. It's the whole notion of gambling questions. They ask you to calculate. What will you do when you can't? And I'm standing there saying, come on, you're going to guess. What are you going to guess? Will it be a number that bears any relationship to anything? No. So, gamble questions, fundamentally flawed ab initio. You have this fantastic balance. I've got a great business and I'm being unbelievably professional. What am I doing? I'm actually listening to my clients' needs, helping them articulate them and meet them. It's not that hard. You should feel comfortable that your clients can rest comfortably knowing that they're well fed and they're protected. Thank you very much.